By all rights, the fact that the current economic downturn has been going on for 4 years now should be a complete destruction of the Keynesian prediction that greater spending will stimulate the economy. And when people do proper science, they know that when predictions fail, the theory that made them has to be modified or thrown out entirely. But with Wu, that just doesn't happen. Things get retrofitted, or the data manipulated or cherry-picked to try and make out like the theory is right all along. Enter Keynesian apologists and government stooges such as Paul Krugman. The problem with the economy, they say, is that there wasn't enough stimulus spending. Never mind the fact that the combined total of bailout and stimulus money from the government plus money created from the Federal Reserve totaled over $20 trillion. Oh, if only these horrible free market people hadn't got their way. Huh? When did we ever get our way? We would have been able to spend even more and get us all the way out of this recession. Yeah, and the patient's not getting any better because we didn't use enough leeches. The problem, so they say, is consumption. Consumer spending just isn't what it was. So we need government to spend to pick up the slack. Until we do, we won't see a recovery or jobs or anything like that. Listen to Krugman himself. How do people who want us to slash the budget deficit now think this is going to work? Unless the confidence fairy arrives, causing households and businesses to suddenly ramp up their spending despite high unemployment and weak sales, deficit reduction will only intensify the problem of excessive savings relative to perceived investment opportunities and make the slump much, much worse. I know, families are having to tighten their belts. So the government should tighten its belt too, and we'll tighten our belt all the way to a full-on depression. The problem is he's just wrong. Consumption is greater than it was before the financial crisis, and has been for almost 2 years now. Here's the data from the Bureau of Economic Analysis, and no, that's not some group of Republican shills or some wonky libertarian think tank. This is our own government. What do our government's own figures say about consumption? This chart, made directly from BEA data, shows it all. This chart shows index numbers of personal consumption normalized at 100 to 2005 levels and is seasonally adjusted. As you can see, consumption peaked in late 2007 and dropped big in 2008 as the recession went into full swing. But then, by mid to late 2010, consumption had returned to its pre-crisis levels and has been growing ever since. If these economists were right, we should have been out of the recession for 2 years now. Well, that's just consumption by Americans. What about the rest of the world? How many of them are consuming American goods? It must be the fact that our jobs have all gone overseas, so no one else is buying American goods, right? Maybe if we get exports up, the recession would be over. But again, according to BEA data, that just doesn't match reality. Exports actually peaked in early 2008 before dropping due to the recession, and in mid-2010 had already reached their pre-crisis levels, and like consumption, they've been growing ever since. So what is the problem? Well, what's the only portion of private GDP left? It's investment, saving. The very thing that Krugman and other acolytes of Keynes say is the problem. Too many people and businesses saving means too much money being hoarded, stuck in a liquidity trap. And that's money that doesn't get circulated in the economy, or so they say. To quote Paul Krugman, "We're awash in saving with no place to go." So with all this growth in consumption and exports, investment must have really skyrocketed in order to counter all this growth, right? Well, guess what? According to the BEA, our government's own statistics, investment peaked in early 2007, fell ahead of either consumption or exports, and slumped in 2009, never to reach its pre-crisis levels again. These graphs show quite clearly that the predictions of Krugman and other Keynesians have once again failed utterly. Trying to stimulate the economy by creating money out of thin air and pushing down interest rates just doesn't work. Without investment capital, companies can't step up production and create new jobs that we so desperately need. With negative real interest rates, investment is a money-losing proposition, and people invest to make money, to make a return on their investment, an extra profit in exchange for deferring the wealth they would have consumed with that money. So who are you going to listen to? The Keynesians whose predictions have failed, just like they have always done, from the Depression to World War II to the post-war economy to the 1970s and pretty much all of this past decade? Or to the ones who not only made successful predictions throughout the 20th century, but also saw the housing crisis and the collapse of the financial bubble coming? And I mean actually predicted it ahead of time, not retrofitted it Sylvia Browne fashion to make it look as if he'd predicted it like Krugman did. I mean the ones who pointed to fiscal and monetary policy, overregulation, the moral hazard created by the CRA and Fannie and Freddie, the danger of low interest rates, and so on. The ones whose evaluation of the economy actually matches what our own government statistics show us about what's going on, without having to cherry pick and retrofit and distort the data. Interest rates need to be allowed to seek equilibrium again. The point at which the investment money that firms need to expand is matched by the amount of money people are willing to invest. And government needs to stop spending like a bunch of drunken sailors, increasing the debt and crowding out investment opportunities. We need to ease the regulatory burden, reducing uncertainty, and allowing firms to make better predictions about the cost of expansion. After all, who's going to hire with all this uncertainty about how much a new employee is going to cost the firm, in terms of healthcare coverage and other regulatory costs that just keep getting piled up year after year? We need to eliminate, or at least reduce, the 35% corporate income tax, the highest in the world. The truth of the matter is, corporations do not pay taxes. When corporations are taxed, the money has to come from somewhere, and there are only 4 places it can come from. 1. Consumers, who now have to pay higher prices to cover the additional costs that the corporate income tax comprises. 2. Workers, who now face lower wages or being laid off entirely because there isn't enough money to pay them all. 3. Reinvestment, which is the money that gets put back into the company to expand, invest in the technology that increases production and lowers cost, and to hire more people and raise wages, while delivering the product to the consumer at a lower price. And finally, 4. Profits by owners, stockholders, etc. Now you may say, yeah, stick it to these rich bastards making their money on the backs of the proletariat. But there are 2 things to consider. The first is that these aren't all rich tycoons. They're old ladies with their pensions, families trying to save up enough to send their kids to college, ordinary working class people like you and me who try to get by and still have enough for the future. But even if you choose to ignore this and insist that it all gets taken up by rich, fat, cigar-smoking robber barons, there's still the second point, which is that you can't control where the corporate tax money comes from. And neither can anyone else, not the government and not even the corporation itself. The complexities of budgeting a corporation means that they can't just move money around willy-nilly wherever they want. Not if they want to stay in business at any rate. So if it's those making the profits that you think should be paying the cost, what you want is the capital gains tax, which for short-term capital gains, which is what we're talking about, is at that same 35%. If you insist on the foolhardy tactic of taxing these people more, this is the tax you want to increase, not the corporate income tax. There just isn't any real reason for the corporate income tax. All it does is create economic destruction, destroying jobs, lowering wages, and increasing prices for consumers. And that's just the opposite of what we need to have a growing economy. So to summarize, now that we've revealed the Keynesian analysis for the woo it always turns out to be, we're left with the following remedies. Release the stranglehold on interest rates and allow them to seek equilibrium. Reduce or eliminate the corporate income tax. And dramatically reduce government spending and deficits, which worked after World War II, which is working right now for Estonia, which has worked every single time it's been tried, unlike the Keynesian remedy of increasing spending. In short, it's investment, stupid. Doing all this means not only economic recovery, but more jobs at higher wages for you and me, with lower prices for the products and services we buy. In other words, not only a better today, but the ability to save for a better tomorrow as well.